Welcome, yield nerds. In this episode, we will for real, I mean for real, search and find in your brokerage software an equity with a 1,830% dividend yield and a PE ratio of 0.01. If it is too good to be true, maybe it is. Let's dig deeper. Hey, by the way, just so you know, there is no gimmick. You can, on your brokerage software, I use Schwab, I'm not affiliated with it, and I'm not pitching it whatsoever. You can search for a certain ticker. We'll talk about who it is, a former member of the S&P 500, and I will reveal it later today. And once you see it, you will understand who it is, and you will see that the dividend is indeed 1,830%, a PE ratio of 0.01, low debt, as a matter of fact, debt to equity ratio of 0.07, very high cash flow, $21 a share, and the dividend coverage ratio of 920%, not shabby at all. And there is a reason why I showcase this, that is to show the flaw of algorithmic or index-based trading. A couple of things before we get further along. I noticed there are several new subscribers, and I am very thrilled and humbled. We reached 100 subscribers. And for the newcomers, you can actually go find this video called How to Navigate the Channel. It will walk you through how the channel is organized. You can also find the playlist called the Income Investing Roadmap, which takes you step by step into understanding what income investing is all about. My usual disclaimers. I started this channel as a way to document my education of yield investing. This is not investment advice. I am not a wealth management advisor. I'm not in the business of pitching products. I don't have merch. I do not endorse product or politics in this show. All right, let's look at the agenda. We're going to look at what index-based yield investing is all about and the pros and cons of it, the backdrop to where we are today, and we'll then start looking at index ETFs, actively managed ETFs, non-actively managed ETFs. How do you create criteria to filter equities for value investment, and where do you go for the next 2 months? Couple of things, and the reason why I say where do you go for the next 2 months is there is indeed a non-zero chance of some kind of a default in summer 2023, and it's terrifying but absolutely possible. So with that on the horizon, we all need to think very smartly about yield investing. And the effect of a default, as we saw in a previous episode, would be catastrophic. Under normal conditions, the price of a dozen eggs would go up by a couple of percentage points a year. We call that inflation. If there is a default and currency instability, if a dollar is worth nothing, how much is an egg worth? What would you pay to have that egg? When there is currency instability, we saw in other countries a price of a dozen eggs or salads in England and so on. It could go up astronomically. So let's not take debt ceiling crisis very lightly. There is a real problem, and we need to think very smartly about it. In Yield Nerd, we do this thing called a Yield Super Bowl. If we looked only at treasuries over the last 6 months, the trends are shocking, to say the least. The blue line here is September 2022, a short 7 months ago. And remember, these returns are state tax free. So in reality, in the last 6 months, short-term interest income from treasuries has gone up by 67%, somewhere around 3.2 something to north of 5. Right now, 3-month bonds pay 5.11%, and there is a good chance it is going to go up on May 3rd in the next FOMC meeting. It is stunning. And you can actually get 2-year bonds or 18-month bonds that pay more than 5%. Again, numbers like this haven't happened in 25, 30 plus years. And so these are state tax free, as you know, as you have seen in prior episodes. So with that as the backdrop, we're going to look at what we ought to do. And my humble opinion, and you do your own math on that, is to invest in such a way that you have plenty of cash in summer as we get towards the yield event or the potential yield event. Understand value investment thesis. There could be an equity crash in the middle of summer. And you need to think through that and possibly look at short-term yield instruments until then. That is the strategy. But having said that, we do want to be prepared for what do you do when indeed there is an equity crash, or if there is an equity crash, and let's hope there isn't, but all pointers say that there indeed will be one if the debt ceiling crisis doesn't just vanish into thin air. So we're going to look at what are index ETFs, what are actively managed, and what are non-actively managed ones, and see if we can create a filter to identify the best possible equity for value investment. And I'm not suggesting at all that you or I go buy this now. All we would do is research, wait until the yield event. Maybe you can nibble at these a little bit now, but not go full bore, because there indeed is some instability that potentially would happen later in the year. Well, the S&P is an index that we throw around all the time, and we sit here and say it's the greatest thing. If you invest for 40 years, it goes up by a big number. And there is a lot of documentation how you can just put your money on the S&P on any day, including the day before the Great Depression, and you still would have come out earlier. You just need to have lived 100 years, and that's all well and good. And there is indeed a small problem, in my humble opinion. The S&P index has a weighting based on the market cap of the company. And so if you weight based on the market cap, it automatically gets biased towards the bigger companies. And if you look one level deeper, you are going to see that the company with the biggest market cap, Apple, indeed is the biggest contributor of the S&P index. The top 4 stocks alone can move up or down and contribute to a 15% move of the index. The top 10 stocks, and you can see who they are here, there's a lot of tech, and that's why the S&P has a lot of volatility lately. And the reason there is a lot of tech is simply because they have a bigger market cap. The reason they have a bigger and bigger market cap is because if their management is compensated on stock options, and you keep issuing new and new stock to compensate them for them to hire at a great extent, as new shares come on board and their share price does not correspondingly drop, then their market cap increases. If market caps increase, their allocation on the S&P 500 increases, and index-based trading will buy more of that stock, and it will prop up the stock price. In other words, robotic buys based on an index will put these stocks on a merry-go-round, and that is some level of contribution. Now, I don't want to say that is the only thing that's happening, but there is some level of the tail chasing the dog here, and that creates confusion when you do index-based trading. So let's understand what an index-based trading is. Ultimately, if you just say, I'm going to buy everything in a basket, that is an index. So maybe you should look at a non-index based fund. Now, what is a non-index based fund? Full caveat, I'm about to mention a couple of fund names. I am neither shorting them, nor do I have any allegiance to them. This is education and not advice, so I want to reiterate that. I'm going to look at a couple of them. These are SCHD and SPYD. Both of them go after dividends. And the reason I talk about dividends is when the short-term interest rates drop, there will be a big run towards dividend-based stock. Presumably, if the dividend-based stocks fall in price, then the dividend yield will increase. This becomes the kumbaya. And so you can imagine a really good index-based dividend investment would say, I'm going to only look at companies that consistently pay dividends. They should have paid dividends for 10 quarters. I'm going to look at companies with good financials. And every year I'm going to go weight this and I'm going to adjust it. I'm going to effectively trade based on a formula. And the fancy way of doing it automatically would be an algorithmic trading. Doing it in an ETF would be actively managed. And so let us see how these things work. Let's look at what the catches are. The very first thing is sector insensitivity, meaning there may be a sector, earlier in this year, the banking sector had a lot of stress. Well, if you only adjust once a year, and if you automatically incorporate stocks that have been paying dividends for, 10 quarters, and it met certain criteria, you're going to put a pile of stocks of a certain sector. You do the math, you look through these ETFs. The bottom line is that there is some sector insensitivity. Sometimes some sectors are overrepresented, because they pay more dividends. And when the macroeconomic outlook changes for those sectors, the ETFs get burnt very quickly. Yield variability is also there. Dividends are not a certainty. You may remember a company can say, we're not paying dividends, we just don't have enough money. And economic pressure adds to that. Last but not the least, you can look at these two funds. And again, I'm not saying anything positive or negative about any of them. Today, they pay a dividend of 3.6% at zero risk. You can get 5% plus sales tax in Illinois, that is 5.3%. You tell me why you would put your money in a dividend-based fund today, and I'd love to hear that. And so the point here is that buying an index-based fund based on criteria doesn't exactly do the trick either, because it has a lot of these gotchas. And so then you may say, I know what I need to do. These kinds of funds are not actively managed because they automatically buy based on criteria. We need to buy an actively managed fund. Let's see how that works out. So we're going to sit here and say we're going to look at all the actively managed funds, compare them to the performance, and there is plenty of research, including one from last year. Buying an index fund is better than buying an actively managed fund, but you already saw what happens to index funds that are only adjusted once a year. So then you have to do a head scratcher, and this is a CNBC article, and say, so if actively managed ETFs are not the right deal, inactively managed or unmanaged ETFs are not the right deal, where do I turn? And perhaps it's algorithmic trading. So let's see how that works. Somebody somewhere will need to come up with a criteria. There are ways in which you and I can do algorithmic trading, as scary as that sounds. All you would do is create a filter. Full disclosure, this is from Schwab. I'm not endorsing them. They do not offer an algorithmic trading platform for you and I. They do have it for extremely high volume traders, and I'm not recommending that or not. So here is how it works. You would go there and say, well, I only want to buy US-based stock, or maybe you want to do international. I don't like ADRs because there are a lot of fees that are levied both on the purchase, the sale, and the dividends of ADRs. Check your statements and you will see. Volume, you do not want to buy a stock that doesn't have a lot of volume because it's hard to sell and you lose. The spread is really high when the volume is low. So suppose I said treasuries pay 5.11%. I want stocks that pay north of 5.11%, and I want that stock to have a fantastic coverage ratio, meaning I want that stock to make a huge amount of EBITDA so they can pay that dividend over and over and over again. So I'm going to look at companies that are swimming in cash, free cash, that pay a lot of dividends, have high trading value, and oh, by the way, I'm going to be greedy and say I also don't want to pay a lot. I only want to pay a multiple of less than 20 of earnings. As you know, the market's earnings is around 24. So I'm asking for a discount. So I'm looking for cheap stock that makes a ton of money, pays a good amount of dividends, has a lot of trading volume, and oh, by the way, I would also like stock that doesn't have any debt or very little debt. And while I'm at it, can you just give me those, shares, those stocks that have a really high cash flow? So the combination of all of these would indeed make for a stellar value investment. In theory, you should be able to close your eyes and say, this is it. Anything that matches it, we should buy, period, end of story. Or is it? Remember the star that I told you? 1,830% dividend yield, coverage of 920%, P ratio of 0.01, and debt of 0.07, which is nothing, $20 in cash flow. Are you ready to know who it is? The answer is Signature Bank. Do you remember what happened to Signature Bank? They were shut down 10 years ago. If you had an algorithm on March 15th when this stock went to a penny, your algorithm would have bought it. This used to be part of the S&P 500. Again, if you had an ETF that bought the index, you owned Signature Bank. You also owned Silicon Valley Bank that also went underneath. And I'm not here to diss on any banks. All I'm trying to tell you is to hang your hat on an index or to hang your hat on an algorithm. is just not the right thing. So, what does it all mean? The moral of the story is there is no substitute for research. Use your time wisely, even in something as solid as US Treasuries. If you did your research, you will see that there is a yield event. So, you don't want to blindly go into US Treasuries with long durations. There is an interest rate risk there. An index that automatically picks the best investment of the week is still a scary thought. Passive investing is not really passive. So what do? And I use the proverbial example of the ice cream, meaning you really want to stay short term. The cherry is in the short term, the ice cream is in the short term, but that ride may be coming to an end. But until it ends, you still want to stay very short term. The debt ceiling drama will have an impact on fixed income and equities. Let's keep learning about value investing. I'm spending a lot of time understanding my strategy on that, but I'm going to sit tight, maybe nibble on something here, something there where I think it's recession proof. And what I mean by recession proof, and there is no such thing, you may remember there is a previous episode that talks about what happens to the price of coal in a recession, what happens to the price of rock salt. So you want to try and understand companies like that. Having said that, get ready to rumble. Email questions, comments to yieldnerd@gmail.com, and thank you for your support. Thank you for listening to Yield Nerd, a do-it-yourself show for yield accumulation and management.